Welcome to Talks with Dr. Gupta and Friends. True financial strategists do not trade on tech evangelism. They evaluate global markets through balance sheets, capital expenditure trends, and yield curves. Looking at the financial landscape today, the AI market has undergone a fundamental structural shift. The honeymoon phase of raw speculation is over, replaced by a ruthless institutional reality check. In previous years, the trade was simple: buy hardware. Hyperscalers in the United States, namely Microsoft, Alphabet, Meta, and Amazon, poured hundreds of billions of dollars into data center buildouts. That tidal wave of capital sent hardware anchors like Nvidia, chip design giant Broadcom, and Taiwan's foundry powerhouse TSMC soaring to historic valuations. However, Wall Street is now demanding immediate verifiable returns. While semiconductor supply chains, fed by Dutch extreme ultraviolet monopoly, ASML, still maintain strong order books, enterprise software firms like Salesforce and Adobe, alongside unproven AI software startups, are facing severe valuation compression. This brings us to the core question: is AI a bubble? My verdict is precise. AI is not a profitless dot-com bubble like the year 2000, but it is a hyper-concentrated industrial build-out facing dangerous structural bottlenecks. Companies like Microsoft and Meta generate massive, highly resilient cash flows from cloud services and digital advertising to fund their infrastructure bets. However, the systemic risk lies in two vulnerabilities. First, the eye-watering operational burn rates of private research labs like OpenAI and Anthropic, which rely on continuous private capital injections while searching for software profitability. Second, the unprecedented rise of debt-funded data centers across North America, Europe, and Saudi Arabia, where hundreds of billions in private credit and high-yield corporate bonds back physical assets that assume uninterrupted future demand. AI is a genuine industrial revolution, but Wall Street has priced in a flawless execution that global macroeconomics rarely allows. In part 2 of our talks with Dr. Gupta and friends, we examine global macroeconomic risks and what this means for students preparing to enter this volatile economy. Any sophisticated investment thesis must account for two geopolitical realities. First, aggressive tariff escalations between the United States and China continue to fracture technology supply chains, raising hardware assembly costs in secondary hubs like Vietnam and Mexico. Second, escalating tensions involving Iran in the Middle East threaten major shipping lanes in the Strait of Hormuz. A spike in crude oil prices directly increases electricity costs worldwide, making the massive power grids required to run AI data centers in the US, Germany, and South Korea exponentially more expensive. This volatile landscape brings a critical responsibility to young people studying economics, finance, and artificial intelligence at schools and universities across the globe. From the US and Europe to India and East Asia, students must prepare for a more complex professional world. If you are a student preparing for a career in finance or tech, relying on traditional textbook formulas is no longer enough. To build an unassailable career over the next decade, you must develop three specific skill sets. Skill 1: AI-augmented financial engineering. Traditional financial modeling in Excel is rapidly being automated. Students must learn to integrate Python, PyTorch, and AI agentic workflows directly with real-time financial tools like Bloomberg terminals to execute complex data analysis at scale. Skill 2: energy systems and infrastructure economics. The primary bottleneck for future technology is no longer software code, it is physical infrastructure. Students who understand power grid economics, nuclear energy financing, and utility capacity will be uniquely positioned to price technology investments accurately. Skill 3: geopolitical risk and supply chain modeling. In a world defined by trade tariffs and regional conflicts, financial analysts must know how to model macro-political shocks on corporate earnings. From semiconductor choke points in Taiwan to energy disruptions in the Middle East, students must be prepared to quantify these risks. Welcome back to Talks with Dr. Gupta and friends. Now for our final takeaway: why traditional academia is falling behind and how we fix it for the AI era. If the skills required by the global economy have shifted so dramatically, we must ask an uncomfortable question: Is the traditional 4-year university degree still relevant? My answer, as an institutional strategist, is straightforward. No, the rigid 4-year higher education model is increasingly obsolete. By the time an academic curriculum is written, approved by university committees, and taught over 4 years, generative AI tools and industry standards have evolved completely. Graduating students with tens of thousands of dollars in debt using 4-year-old software frameworks is an educational disservice. I advocate for an immediate, radical reform of university degree structures built around two core transformations. First, the transition to a 2+2 modular hybrid model. Universities must abandon 4 years of purely classroom-based lectures and instead offer 2 years of intensive foundational theory focused on mathematics, economics, computer science, and logic. This should be followed by 2 years of paid, industry-integrated co-op apprenticeships with major firms like Goldman Sachs, Palantir, Microsoft, or NVIDIA. Second, industry co-designed, stackable credentials. Rather than static degree majors, academic departments must partner with leading technology and financial institutions to issue dynamic micro-credentials that update every 6 months. Students should graduate with verified, real-world project portfolios, not just theoretical transcripts. For students, parents, and academic leaders listening today, the future belongs to those who blend fundamental analytical thinking with agile, real-world execution. The global economy is changing at breakneck speed, and our educational institutions must adapt or be left behind. Thank you for watching Talks with Dr. Gupta and friends. Stay sharp, stay informed, and let's keep analyzing the forces shaping our world.